Hello. We're going to look at Lemonade's Q1 2022 shareholder letter that just came out earlier today. Some high-level information and some high-level thoughts and some nuanced thoughts that I had after reading the letter. So let's dive in here right away. Some high-level numbers just to throw at you. $419 million in force premium, up 66% year over year. Premium per customer, of course, continues to rise, $279, 22% year over year. Just crossed 1.5 million customers. And gross loss ratio, it continues to be a little bit high, down from a year ago when they had the Texas freeze, but still at 90%, so still definitely higher than they would want, which is more around the 75% range. Gross earned premium up 71% year over year, 96 million. Jumping into the next slide here, they talk about growing with their customers and how this last quarter was interesting and kind of exciting because it was the first quarter all of their Lemonade products, which is renters home, life, pet, and car, were available in a market. Not the whole market, not all their markets, but at least one market to take a look, to take a peek, if you use their words, a peek into how meaningful growing with our customers can become as we roll out these products nationwide. The early data are encouraging. Love the grammar. And they go on, they say, after one complete quarter, we saw 40% higher bundled rates in Illinois versus the rest of the lemonade market in the U.S. Makes sense? Just because you have now more products that the average customer might need, they're going to be more likely more people bundling those products together. And the average dual product customer outspent the average single product customer 3-1. For triple product customers, the average was 7-1, and while for customers with all four products, it was 9-1. It makes sense because there could be a lot of customers that spend literally $5 a month or in that range on a renter's insurance product, and that's all they have. And now you're talking about people that maybe have all four products, are 9 times higher easily than somebody who's weighing down the one product average, who could be just car, could be pet, or could be life, but could just be renters and have a very low in-force premium amount that they're bringing in. So it makes sense that is significantly higher. Also, the annual dollar retention in Illinois rose to 90% versus 82% for Lemonade overall. So they're retaining more of the dollars that are in premium or in those products in Illinois because they have more available to what the market actually needs, actually wants comprehensively. And we're going to look at that. I'm going to have some churn numbers as well. We're going to glance at 82% versus 90% in sort of a select market. And this is kind of the strategy Lemonade's been harping on. I've been talking about trying to point out in a lot of my videos that they should be able to grow organically as their products roll out nationwide, as all their products, I should say, become available in each market that they're in, and also as the customers in existing markets that they're in mature over time. And they mention that here, passage of time, our customers go through predictable life cycle events, moving, buying a home, getting a car, starting a family, all with dramatic implications on their insurance spend and no corresponding marketing spend on our end. And then they go into some more details here. I won't read it all for you, but how single product customers grew 61% year over year, and more if you had two products, you grew at 140%, and if you had 3 products, you grew at 390%, etc. And they had a year before that, they had no 4 product customers, so they can't compare that. But it makes sense that continues to grow as the products that are available are bigger ticket items and as customers mature in their own life. And so really, if you think about it, what they're talking about, if there's more bundling of products and the base is maturing over time, and this sort of trend just keeps happening as you have products available in the markets that they're in, and then the customers in those markets continue to mature. Of course, you continue to add younger customers, and then eventually they continue to mature and also bundle more products. That should equal more in-force premium for less sales and marketing. I think this is a really critical metric to be watching in the coming months. We should be seeing more in-force premium coming in for every dollar of sales and marketing that we're spending, because you should be leveraging these two factors. You also should be able to see less customer churn over time. We'll have a glance at that here in a moment as well, but should see less customer churn as customers are happier because they have all the products they want, and as customers are in a more stable place in life and they are more mature and they're not bouncing around moving apartments and just getting renter's insurance, but now they have a house and a family and maybe several cars and life insurance, et cetera, maybe a pet, on and on. So more stable, and it should equal less churn. So this is a spreadsheet that I walked through in a lot of detail in a previous video, which I will link up above in the corner there if you're interested. But in this spreadsheet, I looked at Lemonade's marketing spend and trying to get a sense of how efficient and effective is their marketing spend. Is it becoming more efficient, more effective over time? Is it not? So trying to have a look at that. There's sort of a master sheet of the data. I will link this down below in the description, so feel free to have a look at it yourself or make a copy and play with the numbers yourself. But if you look at one, I think really important one is the in-force premium you're gaining divided by the dollars you're spending on sales and marketing. This, in theory, should rise over time as they expand the car, especially as they expand Lemonade Car across the U.S. and as all those four main products are available throughout all the states that they are in. All the states in the U.S., really across the whole nationwide. Eventually, if Lemonade pushes into other countries, into Europe with more aggression, they could see some fluctuations in this number down the road. Maybe as they're aggressively pushing into new markets and taking kind of just the renters market or some of the baseline products in new markets, that could weaken these numbers. But as you get more of that customers maturing and more bundling as the products people want are offered, these numbers should improve. Haven't seen crazy improvements yet. Here's a graph, quarterly graph of that metric here. So we have improved slightly from Q4, but again, really, there's been too few products and too few places yet to really be able to evaluate this. But my hunch is that as the Metro Mile acquisition closes, as Lemonade Car is available all the way across the U.S., this should rise, I would think, pretty dramatically. Otherwise, if it doesn't, there's probably there may be deeper issues with how effective their products are, and how effective their marketing spend really is. But in my opinion, this metric is really important to watch because it's kind of a leading metric of how effective is their marketing occurring and how effective is this bundling and maturing of the customer base effect occurring as well. So this should rise or there's more organic growth, so you're getting more growth for the amount of dollars you're spending. Another thing to look at is the annual dollar retention, which is kind of confusing. I worked it out in that marketing video, how to get the customer churn rate from these numbers. I think some people are a little bit misled by these numbers, but this is really a function of the amount of dollars premium that are being held over a 12-month time period from kind of one cohort of individuals 12 months ago to today. So I've taken those numbers, and again, you can see that math in that other video that I linked, and I've plugged that in here. You can get the annual dollar retention. So you want this to rise. I mean, in theory, this could actually go over 100%. So you want this to continue to rise. It's kind of leveled out at 82% right now. But from that, I have calculated the churn on a 12-month basis. So this would be every 12 months. This is the customers that are churning. And so we're at about 33%. It's actually trending down. So that's really great to see. And if I show you the graph of that, you can kind of see all the way back from Q3 of 2019 to now, it is slowly trending down. And then if you plug in, this isn't really exact science because we don't have the specific numbers on customers and the specific numbers on the amount of in-force premium and the amount of premium per customer for just Illinois. But they did give us the value that they said in Illinois alone, we're at 90% ADR. So if we did plug that in and just use the base national averages though, but say 90%, if we were at that, then your churn drops to 26%. I'll just show you that on the graph. So that's 26% instead of we're at 34%. So that's a major improvement in a 12-month customer churn. And again, we should see this theoretically improve as more customers have all the products they want available to them, and also as a certain slice of the ever sort of growing slice of the customer pie, those customers get older and are more stable and less likely to just be switching around their insurance needs or canceling a product and going to Europe to backpack for a year or something. Those kind of things that a younger person might do. And then jumping back to the earnings report, they talk about the loss ratios, and they talk about their machine learning models, which are trying to predict from a customer's sort of lifetime value assessment whether a certain customer is good or not. So I'm sure there's just a ton of factors and data points they're feeding into that to try and assess whether what the lifetime value of a certain customer would be. And they say they're on their 5th generation of the machine learning model. So I think that probably puts on, that means they're kind of doing probably a major revamp of the model, that machine learning model, once a year. But anyways, they're expecting a loss ratio comfortably within their 75% target right now. I mean, right now they have a 90% loss ratio. So, I mean, what does that really tell you if they're 70? They're saying, yeah, right now they're going to be 75%. I'm sure they were expecting something more along those lines before for the current quarter, previously, but now they're at 90%. So obviously not exact. The 75% is more of a guess from their model. But they do make some good points here, saying loss ratios are lagging indicators. Improvements in pricing, underwriting, and segmentation take time to get approved, and yet more time to earn it in. This lag act between action and result is a structural nuance in insurance, which is why we use predictive machine learning models rather than backward-looking loss ratios in our day-to-day management, which makes sense. They're trying to see into the future as best they can. Though inflation has introduced an additional cost to this passage of time, so that's interesting as well. That they say, as they point out here, it's reported by all insurers our Q1 loss ratios were hurt by inflation, as claims were instantly adjusted for inflation, while premium rates take months to adjust. So that's some good. They're pointing that out as well. That's going to hurt every insurer, but we have filed 100 applications for rate changes over the past year and expect to see rates move back in line with risk as we receive regulatory approval. So continuing to adjust their own rates, which of course affects the amount of their own loss ratios over time. One of the questions I asked, which I'll show in a moment here, was on the say questions for the earnings call tomorrow, was I really hope they would maybe next quarter, it would be ideal, they start to break out or show details of their loss ratio on a product by product basis. I think would be really helpful to see under the hood how effective are your models, are your loss ratios, as you have more data and more time with a specific product, is it really getting better, and are all the products getting better, or certain ones spiking, or are they all kind of even more mature products for them spiking over time? Would give a lot more confidence if those are each improving over time, have a trend down each product line. I think would be a really great way, a really practical way to see under the hood and see if their AI, if their machine, if their models to try and predict a lifetime value of a customer and the loss ratio for a segment of customers they're bringing in, whether those are legitimate or really not. And then I just threw this slide in. Nice line trend, just headed straight up, of in-force premium that they continue to grow. They've grown about 3x. They're growing their book of business, in-force premium, about 3x over the last 2 years. And then they also pointed this out. This was the last quarter, but they reiterated this here, so I was happy to see that. I mean, I'm happy to see that. Some people were not so happy to hear the word peak losses are coming, but I thought that's great that they're at least sort of forecasting that, as peak losses are months away. So somewhere in this next year, was my expectation, maybe the 3rd or 4th quarter of this year, that there will be their peak losses. And then they should turn around and losses should start to diminish and then eventually be profitable. And I sort of hinted at this thought that peak losses should be coming, and really we really don't know. I think the jury's out on Lemonade until probably about a year from now, almost, till maybe sooner. I would say at least till we get results of Q4 of this year and then Q1 of next year. Those would be really good results, because I tweeted this out. I said the future of this company, good or bad, should become much clearer after they finish the Mile acquisition and have a couple of quarters with car in full operation. Because until that point, there's just too much. We don't have enough of their full product lineup bundled in enough places. But after the Metro Mile acquisition goes through, and which they still are saying should happen this probably any time now soon in this present quarter that we're in Q2. Once that is completed, then Lemonade Car, I'm going to expect, is going to ramp out quickly across much of the US. And then we really should see proof is in the pudding. Is their in-force premium really aggressively launching up for the amount they're having to spend on their sales and marketing, or not? And then that leads me into some of my say questions here, that the two of my say questions that are higher voted and possibly might get answered. This one is what I was touching on. I really hope this one gets answered. I don't know if it's quite voted high enough, but I said, would Lemonade release loss ratios on a product by product basis? It would give a lot of granularity to investors and give confidence that Lemonade's underwriting and AI is or can be an advantage as products mature. So again, some people are asking in other ones like, hey, what's some good metrics? What's some under the hood stuff we can look at for AI? I'd be happy to hear whatever they want to share with us. So if those questions get answered, that's awesome. But I think this is a practical, very specific, actionable way to show investors, hey, guess what? Here's exactly what happened with our renter's insurance. And it used to be at a 300% loss ratio, and it's down to a 65% loss ratio, for example, whatever it is. And here's our all the other product lineups. They're started up here, and they're slowly, they're coming and down and trending down as we manage the data, rather than just one big lump sum loss ratio, which is kind of skewed as well, because some of the bigger products coming in, like car, are bringing in more in-force premium and are going to have a higher weighting on that loss ratio, even though it's a newer product. So if we could see them even broken out by product, it would be, I think, more advantageous in a really practical way. So this, I don't know if it's going to be answered, but this would be the question I would want answered, absolutely, and would hopefully see next quarter. Like, why not? Like, what do you have to hide from investors? I'd say otherwise. So I would love to see that broken out. And then next question too that might be answered. I think this one is higher voted, more votes, more shares. So this is more likely to be answered. But I said there's been very little insider buying, even as the market cap nears the value of cash and liquid assets. How come? So just I didn't even give them any kind of reasoning. Just said, how come? I did do a video on this. I'll link that up below as in the corner here. And I did speculate on why I thought there might not be some insider buying. Thanks for watching this. Enjoy the call tomorrow. I'll try to be giving an update after I hear the call. And if you haven't subscribed, please do hit that like button. It really helps me out. And remember, it's in the bag.